Welcome back to Global Money Talk live from the New York Stock Exchange. And joining me for the second half of the hour is Tai Wong, who is an independent proprietary trader. Thank you so much for joining me.
Good to be here again.
Well, here we are on Jobs Friday. We made it through the week, Tai.
Yes, indeed, we did.
Right, and although it's been a holiday shortened week, it does feel like every single trading day this week we had a lot going on. So we got the U.S. jobs report finally, an event we've been anticipating all week. We got that non-farm payrolls figure. It did come in below estimates, but still holding well above 100,000, coming in at 142,000, and the unemployment rate also ticking lower. What was your take on it initially?
Oh, you're absolutely right in that it feels like a holiday shortened week, but it's been a long week. I know my youngest kid just went to high school for the first time, and we've had a lot of data this week, a lot to digest, but everybody was focusing on today's data. Mm-hmm. And today's data was, and we'll get into it, it was a little bit more later on in depth, but my sense is that if the market was looking for steak, they got kind of a side salad. So the payrolls number was lower than expected, revisions were lower, but both of those were sort of expected. But then the unemployment rate also came in, ticked down 0.1%. And the market, the headlines all talk about the unemployment rate, I think more so than payrolls, at least for most investors. And then finally, one part that's important is the average hourly earnings ticked up 0.1% from 0.1% higher than consensus at 0.4, and that can suggest a little bit of inflation maybe lurking. So I think it's going to put the Fed in a situation where I think it's going to be 25 basis points, which is why I said the market was hoping for actually really bad news to be good news, so they get 50 basis points. At this point, I don't sense they get that.
And speaking of the market reaction here at the New York Stock Exchange following the release of those figures, we're looking at future prices, and then the market opened at 9:30 a.m. And initially we saw mixed trading for the major averages, but right now at the 11:30 hour, we are seeing the Dow, NASDAQ, and S&P 500 all in negative territory, with the NASDAQ down 2%, the S&P down 1.4%, and then the Dow Industrials down triple digits or over 300%. So it's really interesting to see how the market price action has shifted just in the morning session. And I think it does speak to what you just mentioned, because expectations were different heading into today's session based on people who thought potentially we could get a 25 basis point cut versus a 50. And ahead of that September 17th Fed Reserve meeting with the rate decision coming out on September 18th, we will keep an eye on what the Fed speeches say before their media blackout period, which begins today.
Absolutely right. And it's interesting because the market, the fixed income market and the stock market, they're kind of bifurcated right now.
Yeah.
The fixed income markets have had a huge rally. So suggesting that they think that maybe fixed income traders think that, oh boy, this is a really poor number and the Fed is going to go 50 basis points. But the stock market, if the stock market thought that, I think the stock market would be flat or up on the day, and it's not. So, and we're still, it's only 11:30 or so, give or take, and it's plenty of time before the end of the day. It wouldn't surprise me if stocks came back a little bit towards the close, as strong as the bond market is. And the bond market, there's a lot of issuance coming down the pipe. So for the bond market to show this strength, they're definitely thinking a little differently. And just minutes ago, Fed Governor Waller, who's something considered a weather vane for the Fed, came out and said he would be open to larger rate cuts if the situation warranted. So I think he put it out there, but if you read into the speech itself, he's not saying September, he's saying if incoming data warrants it, we'll have it. He's let it out there. Let's see how the market finishes up, but the market's a little bit confused right now, depending on where you're sitting.
And just looking at the market action across the board, so you mentioned bonds, and we'll be keeping an eye on yields as well, but even the way that the stock market here in the U.S. for the major equity averages reacted, you can tell that there's a lot of mixed feelings when it comes to the details of this jobs report.
Absolutely, absolutely. It's a good day to probably dive deep into sort of the employment report.
Yes, definitely.
If you could bring up graphic 1A, if that's available. This is graphic 1, which is absolutely fine. What this shows is, and I took this shot before the data came out, but it shows this is a really good website, by the way, Trading Economics. It's free. It tells you data for every country. I have it just focused on the United States here. It tells you 1A, or 1 if you don't have it. So it shows you the consensus, the forecast, and the previous. The consensus is really the one that you want to look at. Forecast is merely trading economics forecast, which I'm less interested in because I want to know what the whole market is looking for. So this said the market was looking for 160,000 jobs. Some said 165, but right there, unemployment rate of 4.2%. Average hourly earnings, they were expecting 3/10. Right? So we got 142. We got 4.2 in the unemployment rate, and average hour earnings, as we mentioned, ticked up 0.1%, which is important because it's a mixed report. It's not as weak as they would like it. And so this has been for 35 years, for as long as I've been in the market, this has really been, except for very brief periods, the most important number in the market. It's the first Friday of every month at 8:30. Except if the first Friday is the first of the month, it's not enough time for the Bureau of Labor Statistics to actually get it. So if the first is a Friday, it will go to the 8th. And this is the things that I remember after 30-some years in the market. This is what you absolutely know. So let's move to graphic number 2. Why is this number so important? And it's been occasionally we've had the CPI number more important, like the last couple of years before the last 6 months or so, because CPI was telling the Fed how much to hike. But once we get off that cycle, this becomes a really important number. So why is it so important? People say it's a lagging indicator. It doesn't tell you what's happening with the economy right now. That's true, but it's politically in the United States, and I think in most places, the most important issue is jobs. So the Federal Reserve has a dual mandate. They worry about inflation occasionally when it's high or when it's quite low, but really it worries about jobs. And jobs drive U.S. monetary policy. They're the quickest to react to it. Fiscal policy takes a lot longer because it involves Congress. But if you consider that the U.S. has 70% of the world's investable sovereign bonds and 60% of the world's global stock market capitalization, the U.S. economy and the Federal Reserve are really important to the world, and this is why this is such a number. And then, so for me, it takes on a special significance, and people joke about it. We go to graphic 3, and this is just a personal thing, and that my colleagues and I laugh about. So this is a counter that I made on one day, and it says 95. That is how many payrolls reports I have left until my youngest child graduates from college. It actually will be flipped to 94 as soon as I get home today, because that's how many more payrolls that we have. So we look at, I look at our, I can measure my life in payrolls, and it is a really important number. When I started in this business, people were not allowed to take vacation on payroll Fridays. You couldn't do it. It was just irresponsible in terms of when a market is that busy, you cannot be out, you cannot be off.
I think that really speaks to how many employment reports you have experienced and witnessed. But I also like that graphic that you have as well. You have the map of the United States, a flag of the United States, and that countdown clock. So that's very interesting that you have that
sense of humor, right? You need sort of humor in this market. I mean, I remember JD was just talking. Tesla was up 6% yesterday, and it's down 4% today. And sometimes you get really big moves, especially on payrolls Fridays. And you've just got to laugh a little. If you don't laugh a little, this shop can get real serious and too fast.
Well, I think that number 95 up there really speaks to your dedication, Tai, because we know that work ethic has been shifting across different generations. So perhaps in this environment where we actually do have work from home policies, perhaps people will be somewhere else and not quite chained to their desk at the office.
It's true, and it's changing, and sometimes it's a good thing, right? Before the pandemic, we never realized that we could work from home. And if I work from home every day, I save 2.5 hours of commute. And invariably, some of that time actually goes back into the office.
Yes.
You spend more time in front of your screens because you're comfortable and you don't really have to do all that traveling. So I think it's a good thing. Though I still sometimes get annoyed. I remember at one of my jobs, they would invariably schedule a call at 2 o'clock on Wednesdays, and I'm like, that's the Fed.
Yes,
8 times a year. Can we
2
not?
p.m. Eastern Time.
Can we not do that? So it's not the old habits of you want to know exactly what's coming out and be attuned to it, not be distracted.
Yeah, and speaking of which, Tai, you mentioned 2 p.m. So after the Federal Reserve's 2-day meeting, September 17th to the 18th, that long-awaited, highly anticipated rate decision will be coming out at 2 p.m. Eastern Time.
Exactly.
And we'll be listening for Powell's comments in the presser following that.
Absolutely. You look at the dot plot, and then you listen to the presser with Powell, and Powell's gotten really good at this. I know in the beginning he would say things, and the market would go. And he's gotten he's been a really good Federal Reserve chair, I think. And he speaks in a way that just people understand, which is really important. It's not, because Jay Powell is not just for, folks like us, it's for everybody else too. So to have someone who could, that the regular people couldn't understand is great.
Yes, and absolutely. When we think about many years ago when we had these key events like the jobs report or the Fed rate announcement, we didn't always have smartphones, right? We might have had technology in the form of the web or laptops, but nowadays someone like Jay Powell can become a meme almost immediately after the presser, right? So that sort of speaks to how the culture has changed over the decades and how our access to information is there. So it's not just people like you and I, people who work in financial services or people in the media. It's everyone out there who's looking at social media platforms and they're like, oh, Jay must have said something important out there. So I think that's also very interesting to monitor.
I think Jay Powell, one thing he doesn't want it to be is a meme, but it's inescapable. But he doesn't want to be a meme. He also doesn't want to remember 50 years ago as an object lesson. I think that's how he's going to approach. He's approached his time at the Fed, and how he probably will continue to do so, which is good. Keep things nice and steady.
And I can't imagine Bernanke, for example, becoming a meme, but that does speak to how long you and I have been covering the market.
Yes.
So shifting our focus on back to jobs, let's take a deep dive into the unemployment rate. So as you mentioned earlier, we did see the unemployment rate in the U.S. dip down to 4.2% from 4.3%. And if we rewind a little bit to the beginning of August, right? We had that market volatility on August 5th. We saw all the major equity averages, a lot of assets just see red across the board, and that was in reaction to that unemployment rate, which you touched upon earlier.
Right. So perfect time for a deep dive into non-farm payrolls report, which primarily has 2 sections, and we'll get to the unemployment rate in just a second. But let's first go to graphic 4, and we can talk about the non-farm payrolls. So this is actually what we said, 142,000. It's actually the change in non-farm payrolls. Impressively, the total non-farm payrolls in the United States is something like 157 million people. So it's a lot. So that change is, a tenth or 0.2%, but that sometimes we forget that the base is actually quite large. So, like I mentioned before, and we can see in the graphic here, ignore the forecast. But look for the consensus, which is basically the average of, the sell side forecast or everybody's forecast, 160,000. So when this comes out, when I'm sitting in my chair, I look at that, and then I look immediately at the revisions, because sometimes the revisions can be down or up versus what the number is. The revisions were down today, substantially. I think it was maybe like 89,000 over a couple of months, 25,000 the last month's number, which made last month's number under 100,000. So you look at the revisions. Previous to that, the last 2 months' revisions were 29,000 jobs. Now, what's important to remember is non-farm payrolls, that this number is taken from what is called the Establishment Survey, which is a survey of a sample of 120,000 businesses. And it's considered to be a very reliable number, and it's a number that makes the headlines, and the professionals really look at this number. The headline number is going to have the most impact, but the net number overall as the market digests it. But that's non-farm payrolls. And I think about it, I have 95 more non-farm payrolls until Catherine graduates from college. So let's move on to the unemployment rate, which is the second half, which is just as important. So graphic number 5. So the unemployment rate actually comes from a completely different survey, and it's called a household survey. It's a survey of actually only about 60,000 what they call eligible households. And I took exactly what it is from the Bureau of Labor Statistics. It says it includes the unincorporated, self-employed, unpaid family workers in family businesses, agriculture, and related workers, workers in private households, and workers on unpaid leave. So these are sort of people responding to a survey, families responding to a survey, and they're going to be less reliable than businesses. It's also a smaller sample size. So they basically take sample sizes and gross them up and do a lot of fun actuarial complicated stuff that's far beyond me to figure out what the number will be. So in the past, it makes the biggest headlines. You look at the Daily News, you look at the Post, and you even look at the Times. They'll talk about the unemployment rate, but it's more important now because Jay Powell and the Federal Reserve cares about it. And I think they care about it because it gets a lot of attention, and people care about it. So if you talk about non-farm payrolls, I think that the ordinary investor would be, what's that? But they understand the unemployment rate because 4.2% of the people out of work is something that they can understand. And the unemployment rate has also gained extra significance in the recent couple of years because of what's called the Sahm Rule. So let's move to graphic 6, and we'll look at Claudia Sahm. So Claudia Sahm, pictured here on the right, was a long-serving Federal Reserve economist. I think she was there over 10 years. She's since moved to, she started, I think, a consulting firm. I think she's with the Jane Family Institute right now, which is a family institute of somebody who's running a big hedge fund. And she came up with, during her time as an economist with the Fed, she came up with the Sahm Rule. And the Sahm recession indicator, according to the Federal Reserve Bank of St. Louis, the second bullet point there, signals the start of a recession when the 3-month moving average of the national unemployment rate, U3, because they measure it in different ways, rises by 50 basis points or half a percentage point or more relative to the minimum of the 3-month averages from the past 12 months. So basically, if the moving average goes half a percentage higher than the lowest of the average of 3 months in the past year, it signals that we are either in a recession or going to be in a recession. And as Claudia Sahm explained, since 1970, the rule has correctly predicted every recession and has not been wrong in that time. And it triggered last month, and it ticked up to 53%. And with today's data, it actually ticked up to 0.57%. So now she's been very careful because she's gotten a tremendous amount of attention, and I think sort of deservedly so, because this is something that people can understand, and she developed it as an early warning indicator to what she said would be for the government to add stimulus to the economy. But it's also equally useful, perhaps more useful, for monetary stimulus because the Fed can move a lot faster than Congress. Now, she has said, because of all the attention, that this is not, the Bible. It is not always going to work. And in fact, the fact that we've had higher participation, which has brought the unemployment rate higher, and as well as a historically low unemployment rate may cause this to not work this time. She has said that. But I like this rule. I want to keep an eye on it. I think it's pretty good.
Well, Tai, thank you so much for that deep dive into non-farm payrolls as well as the unemployment rate, because I think it's so helpful for viewers to understand the significance of this data, this report that comes out every first Friday of every month. But I think it's also important that you brought up the Sahm Rule, right? And the fact that even Claudia Sahm herself has said that this is an empirical regularity and it's not a law of nature. And when she came up with this originally, she wanted to automate stimulus checks. So for those who may not be familiar with this, Tai, can you explain why this is so significant?
So I think the idea of stimulus checks, and I guess people understood it more in the pandemic in terms of when a lot of people became unemployed very, very rapidly, to an extent that we had never seen before. And from which we rapidly recovered, due in part to the policies, the stimulus of the monetary and fiscal policies, compared to the Great Recession, which took a long, long time to recover from. And I think we took some lessons from that. But I think the idea was to tell the fiscal authorities that we are either in a recession right now, which again, a lagging indicator. A recession technically is a shrinkage in GDP for 2 straight quarters, which is also a very, very lagging indicator, and says, why do we want to wait maybe 6 months before we help people out? Let's do it a little bit earlier. So this is, it makes a lot of sense. It's just Congress doesn't move that quickly, and to add checks, stimulus checks, is a difficult thing. But I think it's actually useful for the Fed, as we're going to find out perhaps over the next few months whether we actually head into a recession. I think it's a good rule, even if it doesn't work this time. And sometimes, though, it may not work all the time. When you have a rule that works every time for every recession since 1970, sometimes you may have fit the data too cleanly to make sure that everything works. So sometimes a rule is better if it works 80-90% of the time than 100% of the time, because it's a less tight rule. And I remember Dan Ha yesterday saying that if he doesn't like coin flips, but if you gave Dan 80 or 90% chance of something working, he's going to elbow me aside to trade. He'd be so quick at it.
Well, I think that's a very interesting insight you provided with us, Tai. And as you mentioned, we have to keep in mind that cases such as the pandemic that we just all experienced starting in March 2020, that is a once-in-a-lifetime event. So we have to take into account the differences as well as the outliers in this case. And next up, we do want to take a close look at the rest of the employment report that came out in the U.S. for the month of August. But very quickly, let's take a look at where markets are trading in New York Morning Trade. So we do continue to see red for the major U.S. stock averages. When we look at the Dow Jones Industrial Average, it is off by triple digits, down by over 350 points, or 0.9%. And the Nasdaq Composite Index is extending losses from earlier in the session, down by nearly 2.5%. And it is off by over 400 points. The S&P 500 is also lower as well, down by nearly 1.6% at this 11:30 hour, and is hovering above the 5,400 level. So, Tai, we are seeing extended sell-off here in New York Morning Trade for the major U.S. stock averages. So I think this is a good time right now to take a deeper dive into that jobs report, because it's not just the unemployment rate, the non-farm payrolls, but there are other juicy details. So tell us what's going on.
Sure. Let's look at the rest of the report. Graphic 7, I call it the rest because there's some important bits, but they're worth looking at. So in the red boxes, we have average hourly earnings. So that's important when you're really worried about inflation. So a year ago, 18 months ago, when inflation was raging, the Fed was looking very, very closely at that because they were afraid of a wage price spiral. That because we were coming out of the pandemic and participation was down, and there were 12 million job openings on JOLTS, that people would demand and get more and higher wages, and that would drive prices higher. That has happened in the past, or something they're really afraid of. So with inflation tamping down right now, they're not so concerned about that. The participation rate had gone up in previous months, which means there's more people looking for work, so the unemployment rate sort of looks higher. It stayed flat today, so I think they'll keep an eye on that, but it'll be a little less important going forward. What's important, when we think about it, it was a participation rate. It tells you a lot about a country's job population. So the participation rate was much higher 10 years ago. It was probably somewhere in the range of 66 to 67%. And what that means is probably demographic, that we've had the baby boomers, the last baby boomers are starting to retire, and the pool of available workers is actually smaller compared to the population, which is why participation is down. And then finally, at the very bottom here, is the U6 unemployment rate, which is the underemployment rate, and it tells the market, it tells the Fed that for people who have a job but they don't have a full-time job, but would like a full-time job, how much that is. That is still relatively low compared to where it's been over the past 15 or 20 years. So not really a big concern, but something worth taking a quick look at. And then probably the stuff in the middle, obviously private payrolls are more important, I think, than government payrolls, because private payrolls means somebody is growing the economy, whereas public payrolls is really just the government going. The government doesn't often produce stuff and add to GDP, so really private payrolls can be important. But this is the rest of the report. The most important, as we've gone through before, is the payrolls and the unemployment rates.
Well, Tai, I think this is very helpful, and for you to go over each individual line item. And I'm glad you brought up the U6 number, because that is something that we have been keeping our close eyes on. And I'm sure this entirety of the jobs report will be a topic that we'll be hearing in that presidential debate coming up next week between the two candidates. Yes. Because, as you mentioned, jobs, right? The economy, these are key things that Americans are paying attention to.
Absolutely, especially in sort of the so-called Rust Belt states like Michigan and Pennsylvania, where people. In the last election, 80,000 people literally decided that election. If 80,000 people, the right 80,000 people, so to speak, or the appropriate, I should say, switched their votes in enough states, Trump would have been president again. So that's why there's so much focus on it. So much focus on, why we don't want to tax tips, and both sides have actually jumped on. I think Trump had it first, and Vice President Harris said, "This is a great idea. I want to get on that train as well." But jobs are really, really important. That's what this election is going to focus on.
Yeah, and if we look at the non-farm payrolls to see where the jobs came from, we saw healthcare as well as construction. They saw gains in the latest month, but at the same time, manufacturing production jobs saw a decline.
Right. Manufacturing, it's in a tough spot. Other countries just can make things cheaper because they pay lower wages. So it's in a tough spot. So that wasn't entirely unexpected. But it was good that we saw a good private payroll growth. It gives the Fed, I think, a better sense that we can start slow, and if we need to go faster, we can go faster. That's why I do think it's going to be 25 basis points as it stands now.
And Tai, I do want to ask you about your experience with this employment report. So as you mentioned, you gave us that 95 number initially, but what has been your experience? Because when we think about earnings reports, for example, financial services companies, after some of the big names report their earnings, despite what the results are, top line, bottom line, guidance forecasts, we might see shares pull back. But in the case of employment reports, historically, what have you seen in terms of reaction across the markets?
Well, let's take a look at, I think it's, let's look at the graphic number 8. And as a trader, so this was actually, wasn't even expected. This was Wednesday when JOLTS came out. And you can see in that yellow oval, gold rallied $10 in seconds. And as a trader, you have to deal with this volatility. So that was a particularly tough one because you didn't expect it. JOLTS is a number they look at, but it doesn't usually move markets this much. So let's look at this morning, and hopefully they managed to get this. So do we have graphic number 9? Sorry, maybe it was 10. I apologize. Yes, this is it. So, I apologize for the because it's a per minute chart and may not be so clear. But when the jobs report came out today, gold moved $22 in a minute. In fact, I watched it gap, and it gapped first lower and then instantly rallied. So how do you deal with that? And it became an art. As a trader, the payrolls report. I remember I said you were not actually allowed to go on vacation in the early days when this came out. In the early days when I was in the market, because you knew at 8:30 something would happen. Now the technology has gone so grand. If we go back to graphic 9 when you have a second, the one before that would be awesome. You could watch a report and then trade, but you can't really do that anymore because the machines are so fast. I watched a gap and my first reaction was, oh my God, must have been a really strong report. And then I saw the print and it said, the site I was looking at said, average hourly earnings up 0.7%. It was an error. Right? And I think a machine read that error and said, oh my goodness, wages have really gone much higher. What do we do here? So, and then when they realized that was an error, gold instantly started to rally. The machines took in the numbers. But I don't look at the update anymore. I actually look at how gold or something else reacts real time, because the market works in milliseconds now. I mean, if it takes a second for the Bloomberg or whatever I'm looking at to update, and a second for me to actually react, it's too late. The market's gone. The market's gone. You might be interested to know that there are certain hedge funds, sort of high-frequency traders, low-latency traders who need to move really fast. They pay tens or hundreds of thousands of dollars to put their servers in the same room with the Bloomberg servers, so they won't be 10, 20 milliseconds late when the data comes out. Because if your server's in Chicago and you're half a second late because of that, somebody's way ahead of you. So it's really remarkable. It takes sort of the human out of the situation. So how do we react to that? I think as a trader, you need to, if you have orders, you need to have your orders in ahead of time. So you have to know when it's coming out, where your orders are, important orders you have to fill. You have to have them in. You also have to be careful not having stop losses. Let's say you were long and you were afraid it would be a good number. If you put a stop loss in the downside today in gold, it would have cut you out at the lows and it would have gone right back higher. So really, you have to be ready pretty much for all the time. And and the last piece of advice I would say is, people, what do you think of this number? Wait till 10 o'clock on every Friday, payrolls day. Wait till 10 o'clock and have people let the market digest.
Well, Tai, I think this is helping us understand the significance of this report and what it means for retail traders out there. So thank you so much for your company this week, and thank you for weighing in on this all-important jobs report.
It was great to be with you this week. Thank you so much.
Thank you, Tai. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro.TV. And you can check out the show anytime on our YouTube channel by searching Global Money Talk. And thank you so much for joining us. Have a great weekend.